For those people that are unaware of how this works, let's run through how each of these works. And there are three products that we're primarily speaking about today. One is your liquid funds and your ultra short-term debt funds. Then there is the arbitrage funds, which a lot of people had started preferring because of the equity taxation. And then there's the income plus arbitrage funds, which have that fund of fund treatment. By my understanding, Vishal, please correct me if I'm wrong. And so therefore the tax treatment is not as adverse as your fixed income funds.
That's correct. So I think, there are two aspects to it. One is what is the kind of holding period you should have on this money that you have kept aside for shorter term needs to get the tax benefit. And the second is what is the product design itself aligned to. So if you look at liquid funds, for example, they're typically designed for money which is being kept for a few weeks, most often, because most liquid funds will have an exit load up to 7 days. So if you have money, for example, for just a day or two, you may not find the liquid fund very efficient because it has an exit load. What a liquid fund does is it goes and invests in very short term and money market sort of instruments. And the returns there will largely come from the interest income that these instruments actually generate. And therefore, they're a good place to park emergency funds where you don't know exactly when I will require the money, but I expect and anticipate that it'll be a few weeks to a few months. In contrast, if you look at the arbitrage funds, what they're actually trying to do is find equity arbitrage opportunities, which means that if there is a particular stock in the cash market and another stock in the futures market where there is an arbitrage available between the two, the fund manager will try to lock in this arbitrage by buying in cash and selling in futures simultaneously. So the intent is to try to not take risk of directional movement of the markets, but simply lock into the gain at that moment. Now, when that happens, the typical sort of impact is that the volatility tends to be much lower, because if you're a fund manager and you don't find these opportunities, you may end up then parking it temporarily in debt instruments itself. Now, because of the tax treatment in these instruments, which become long term after a 12-month period and then get taxed at equity levels, which is 12.5%, you will typically find that these instruments are ideally suited for 1 year plus if you're doing it purely for the tax reason. But even if you hold it short term, and these are not instruments which are designed in our view for 1 month holding periods, but you need to have at least a 3 to 6 month holding period before you go to an arbitrage fund. If you went there, you would still get a short term tax. And the short term tax for someone who's in a high tax bracket is only 20%. Whereas if he parked it in the liquid fund, it would actually end up being at the marginal tax rate, which could go up to 30, 33, 35%. The income plus arbitrage product basically tries to combine debt plus arbitrage opportunities together. It's a very interesting proposition for a lot of investors in the higher tax bracket because, like you rightly mentioned, Alex, because of the way it's structured as a fund of funds, it gets the benefit of a long-term capital gain treatment. The only difference is that the holding period needs to be at least 2 years to get that 12.5% long-term capital gain. So very clearly, depending on what time frame you're going to hold each money for and which tax bracket you are under, the choice between liquid arbitrage or income plus arbitrage may vary.
Disclaimers: investment in securities market are subject to market risks. Read all the related documents carefully before investing.